Good morning and welcome to today's BetaShares webinar. My name is Cameron Gleeson. I am Senior Investment Specialist at BetaShares. I'm delighted that so many of you could join us here today. We thank you for taking the time out of your very busy schedule. We'll also be joined today by Hamish Preston from S&P Dow Jones, live from New York. Hamish will introduce the S&P 500 Equal Weight Index, and I'll be discussing applications of this exposure within your client portfolios. We've certainly seen a real groundswell of support for our BetaShares Equal Weight ETF, and judging by the numbers on the webinar today, we can see that this is clearly a very topical exposure. So we hope you find today's information both relevant and actionable. Just some housekeeping here. If you could look at the disclaimer slide, all information presented today is general in nature and does not take into account your personal circumstances. For any recommendations of a financial product, please seek the advice of a professional financial advisor. We have some other disclaimers here, and you will get a copy of these slides subsequent to the meeting, so you may review those disclaimers at that point. But I will also point out that Hamish will be talking to the S&P 500 Equal Weight Index. And while the BetaShares Equal Weight ETF does track that index, S&P Dow Jones do not sponsor, endorse, sell, or make any recommendations with regard to the ETF. BetaShares and myself are not affiliates of Dow Jones Indices. So anything that we say has not been endorsed specifically by Dow Jones Indices. Any opinions that I express throughout the webinar. We'd also like to just point out that this webinar is for financial intermediaries and licensed financial advisors only. As I mentioned before, a recording of the session will be sent to you via email after today's session, and you'll also receive a copy of the slides. If you look at the GoToWebinars widget, we can see that you can ask a question by clicking on the questions there. Type your question in, send that in. We're going to try and allow plenty of time at the end for questions, so we'll endeavour to get through as many of your queries as possible and respond in time. I'm sure a lot of you will be aware that the BetaShares website has an array of investor materials. We have blogs, investor insights, thought pieces, product information, and also general information about investing and ETFs. Please visit the website. You can sign up to our Chief Economist newsletter and also connect with us on those various social networks that you see there. So just to reiterate, my name's Cameron Gleeson. My role at BetaShares is to assist clients of all shapes and sizes with investment strategy and portfolio construction across asset classes. It's my pleasure to introduce Hamish Preston from S&P Dow Jones Indices, live from New York. Hamish is responsible for S&P Dow Jones's US equity indices. Hamish provides insights and thought pieces to both investors, clients, and the media across the US equity index space. And Hamish has been involved in index development across a range of areas from global strategy, alternative beta, factor-based indices, and thematic equity indices. Hamish, good evening to you. Welcome. Thank you very much for joining us.
Thank you very much, Cameron, for that very kind introduction, and hello to everyone who's joining us today. Delighted to be here. So as Cameron mentioned, just to be clear up front, so as an index provider, we don't provide financial advice, nor do we make predictions about the market or anything. So instead, today, what I'll really be talking to is the S&P 500 Equal Weight Index. And in particular, what is the index, how it's constructed. Then we'll look at some historical index returns compared to how the Equal Weight Index fared relative to the S&P 500 historically. And then we'll delve into some of the characteristics of the Equal Weight Index that have helped to explain those historical returns. So with that said, what is the S&P 500 Equal Weight Index? Well, the index was launched in January 2003, and it recently celebrated its 18th birthday. Now, as the name suggests, the index equally weights all of the components of the float market cap weighted S&P 500. So what that means is at each quarterly rebalance, which occurs after the close on the third Friday of March, June, September, and December, each of the 500 companies within the S&P 500 are equally weighted and receive 0.2% weight. Now, because of that, the S&P 500 Equal Weight Index measures the performance of the average stock. That's one interpretation of the Equal Weight Index returns. What we've seen historically is periods of outperformance by the Equal Weight Index compared to the market cap weighted S&P 500. So just to give you a bit more detail about that on the next slide, these two charts are showing you the historical index returns of the S&P 500 Equal Weight Index compared to the S&P 500. Now, if we just focus on the right-hand chart for a second, this is focusing on returns for both indices since January 2003 to the end of last year. And since the Equal Weight Index was launched in January 2003 and the S&P 500 was launched in 1957, the right-hand chart represents sort of live index performance for both the 500 and its equal weight counterpart. And what you can see here is that historically, the Equal Weight Index offered higher returns, albeit with higher volatility and similar risk-adjusted returns. Now, with most indices, or the vast majority of them, when an index is launched, it comes with back-tested hypothetical performance to give people an idea of if the index construction, the rules around the index had been in place historically, what would some of the characteristics and performance of the index have been? So that's the left-hand chart. So we have data for both indices going back to the 1970s. So once again, this is back-tested information prior to January 2003, because the Equal Weight Index was not launched then. But nonetheless, what you can see is a similar pattern of returns over that longer period, albeit using hypothetical performance for the Equal Weight Index prior to January 2003. So what that means is, once again, Equal Weight posted higher annualized returns with higher annualized volatility and similar risk-adjusted returns overall compared to the S&P 500. Now, when you look at cumulative total returns, as we were doing for those two charts, what you can sometimes see is periods, isolated incidents of outperformance or underperformance that then compound throughout history. So on the next chart, just to make sure that that's not what drove the outperformance of equal weight on the return side of the ledger anyway, historically. Here we're looking at the cumulative relative total returns in US dollars of the S&P 500 Equal Weight Index compared to the S&P 500. So in other words, when this blue line is rising, that indicates that equal weight is outperforming the S&P 500 and vice versa. So what you can see from here is that there have been long periods of equal weight outperformance historically. There's a steady upward trend in this graph. And there have been particularly notable periods of outperformance, such as after the technology bubble burst in the early 2000s, as well as after the financial crisis. It should be noted, though, that equal weight hasn't always outperformed. You'll note over the last few years, there has been a slight downward trend in this blue line. And as we'll come on to in a few slides' time, that one reason for this perhaps is the outperformance in recent years of some of the largest names in the market. But of particular relevance to the slides today, if you look on the far right-hand side of this chart, you'll see recently there's been a spike, if you like, in the relative returns of equal weight compared to the S&P 500. And we'll return to that and some of the drivers over the next few slides. Now, another characteristic of equal weight on the next slide, looking at the sector allocations, is that the S&P 500 Equal Weight Index has different sector allocations compared to the S&P 500. Now, the S&P 500 is a float market cap weighted index. So what that means is that sector weights are determined by the sizes of the companies in the market and in which sectors those companies fall. In contrast, because the 500 Equal Weight Index equally weights the components, its sector weights are driven by the number of stocks in each sector. Now, where this had an impact historically, for example, is the S&P 500 Equal Weight Index had far less weight in information technology in the run-up of the tech bubble. And that helped to explain some of the outperformance of equal weight compared to the S&P 500 when that bubble burst in the early 2000s. So that just gives you a flavor of some of the differences. Once again, this is all index information, and prior to 2003 in January, it reflects hypothetical information because the S&P 500 Equal Weight Index was not launched. So thus far, we've looked at some of the returns and relative returns of equal weight compared to the S&P 500, as well as sector characteristics. But returning to equal weights relative returns, let's now ask ourselves what things have helped to explain and what factor exposures have helped to explain equal weights relative returns historically. Well, the first one and most obvious one is equal weight has smaller size exposure or bias compared to the S&P 500. And one way to show that, as this chart does, is as of the end of January, you can look at all of the constituents in the S&P 500 and the S&P 500 equal weight. They're the same companies. What you'll notice is that the largest company in the S&P 500 accounted for about 6.7% of the S&P 500, compared to 0.2% of the equal weight index. Similarly, the largest 5 names accounted for over 20% of the S&P 500 versus just over 1%. And then you get the picture, right? Going to the right-hand side, the bottom 400, so the 400 smallest names within the S&P 500 accounted for about 30% of the float market cap weighted index, whereas they accounted for over 80% of the equal weight index. So what this means is that the equal weight index is less sensitive to the performance of the largest names. And it should just be noted that while we're talking about smaller size exposure here, we are still focused on the large cap market segment. These are still large US companies.
Thanks, Hamish. I'll just join you at that point. I mean, I think it's important to consider this from the Australian investor's perspective. As Hamish mentioned, all stocks within the S&P 500 are still large cap stocks. Comparing that to the Australian equity market, the 500th biggest stock isn't large cap. It's not even small cap. It's a micro cap stock. It can be difficult to fathom the size of US capital markets. Clearly, they're much larger companies, much more liquid, and much more efficient, more research down to smaller level of stocks. By way of comparison, if we look at some of the smallest names within the S&P 500, their turnover or their liquidity is equivalent to that of Coles, which is the 27th biggest company in Australia. So these are very large liquid stocks. It's a very efficient market, and the smaller size bias still involves the exposure to large cap stocks, but a skew away from those mega cap stocks.
Thanks, Cameron. And just for a bit more context on how important is this size exposure historically. So research that S&P Dow Jones Indices published a couple of years ago really looked at this and found that the smaller size exposure of equal weight helped to explain about 50% of the S&P 500 equal weights returns compared to the S&P 500 historically. So that just gives you a flavor of how important. Now, one thing we can now ask ourselves is, well, what other factor exposures might be helpful in explaining equal weights relative returns? And another obvious choice would be momentum effects, or more specifically, anti-momentum effects in the equal weights rebalancing process. And just to give you an example, let's consider an equal weight index has just rebalanced. So each company within the S&P 500 has a 0.2% weight. Between that point in time and the next rebalance, some companies will outperform the average stock and their weight will increase in the index. Some stocks will underperform the average stock and their weight will decrease. So when you're just prior to the next rebalance, some of the stocks that have outperformed have a larger weight in the index. And therefore, in order to get back to equal weight, you have to allocate away from those stocks. And similarly, you have to take that allocation and give it to stocks that have underperformed the average stock and so their weight has declined since the last rebounds. So this is pretty much the opposite of what a momentum strategy might do. And so what you would expect to see is equal weights having less momentum exposure than the S&P 500. And this chart really shows you that. And this is taken from our monthly S&P 500 factor dashboard, which is available on our website, spdgi.com. And in particular, if you look on the top right-hand corner of this slide, what that chart is showing you is the factor exposures of the S&P 500 equal weight relative to the S&P 500. So what you can see there on that momentum loading, compared to the S&P 500, which is that dotted yellow line, the momentum exposure is less. And that rebalancing effect really helps to explain that. And similarly, that smaller size exposure, you see all tilts towards dividends, high beta, as well as value. And just on the momentum front, just to finish up there. So once you've accounted for size, the same research that S&P did a couple of years ago found that of the remaining variation in equal weight relative returns that could not be explained by size, momentum or those momentum effects accounted for 50% of the remainder. So in total, 75% of equal weight relative returns were explained by a combination of its smaller size exposure and those anti-momentum effects. Now, just to give you a real-world example of how these characteristics can impact index returns, on the next slide, I've just put together some index returns for last year. And I think 2020 and so far this year has been a great example really to illustrate some of these impacts. So as we're all too familiar with now, COVID-19 came onto the agenda about this time last year. And through the first 3 quarters, what you really saw was the outperformance of large growth momentum names in the market. And that was really driven by many investors expecting the largest companies in the market, which are typically more growth oriented and have those momentum, or did at that moment in time. Many investors expected those companies to be better able to navigate the COVID-19 environment when we're working from home, communicating online. Similarly, smaller companies to which equal weight has greater exposure within the large cap segment, but also the S&P mid cap 400, the S&P small cap 600, they're typically more domestically focused in their revenue exposure. In other words, they're more reliant on the domestic US consumer as a source of their revenues. So when you consider what was happening to many people's economic outlooks and the downward revisions following the so-called COVID correction, that helped to explain through the first 3 quarters the outperformance of the 500 growth and momentum relative to equal weight mid caps and small caps. But really what we've seen since the end of September is a complete reversal in the first 3 quarters, or compared to the first 3 quarters. You've seen small caps, mid caps, equal weight, all outperforming the S&P 500 growth and momentum. And I think a real driver of this has been vaccine announcements and the upward revisions to economic outlooks. In other words, the same companies that were disproportionately impacted during the so-called COVID correction because of downward revisions to economic outlooks were largely the same companies that were disproportionately impacted to the positive side by news that, or hope that we are getting at, or at the beginning of the end of this pandemic. So that just, I think, illustrates some of the characteristics of the indices and how they've manifested in the recent index performance. Once again, we'll have to wait and see what happens going forwards. And frankly, your guess is as good as mine, what will happen for the rest of this year and moving forwards. But nonetheless, I think the recent history offers some insight. Now, another interesting observation, really driven by the outperformance of some of the largest names in the market, and this takes us to the next slide, is market concentration increased recently. And what I mean by that is that the weight of the 5 largest S&P 500 companies hit multi-decade highs in 2020. And once again, that was, I think, driven by the largest names in the market outperforming due to investors' expectations over those companies and how they may be better suited to the COVID-19 environment. Now, why do I bring this up in the context of equal weight? Well, if you take a step back, there's actually quite a tangible link between market concentration and the relative performance of equal weight compared to the S&P 500. And in particular, when market concentration increases, what that really reflects is the outperformance of the largest names. But equal weight, because, and as we've just gone through, has less sensitivity and less exposure to those largest names. Therefore, you would expect it to benefit far less from that type of outperformance and to underperform the S&P 500 when concentration increases. Similarly, when concentration decreases, what you would expect to see is that smaller companies are outperforming their larger counterparts. But we know that equal weight has more exposure to the smaller names in the market, and therefore you'd expect equal weight to outperform the S&P 500 when concentration declines. And that's exactly what we've seen. Going to the next slide. Once again, the dark blue shaded area is showing you the cumulative index weight of the largest 5 S&P 500 companies at each month end, going back to 1970. But that yellow line on top is the cumulative relative total return line that I introduced a few slides ago. And there you can see equal weight typically outperformed after elevated concentration levels. And I think given what we saw towards the end of last year, so that concentration declined, that may help to explain what happened in recent months to equal weight relative to the S&P 500, and in particular, it outperforming. Now, will this continue? Who knows, frankly, and once again, this is not a prediction for the future, rather an interesting perspective that one can take, I think historically, about concentrations and potential linkage with equal weight's relative returns that can put some of equal weight's historical returns in context. Now, the final couple of slides really focus on the role of the S&P 500 equal weight and its rebalancing schedule in potentially identifying future outperforming stocks, maybe to a better extent than the S&P 500. And on the next slide, what I'll just start by saying is that equity markets, if you look at equity returns, they're typically positively skewed. And one way to show that is in the chart on your screen right now. So to compute this chart, you first identify any stock that's ever been in the S&P 500 between January 2003 and the end of last year. Then you calculate each stock's returns for the period it was in the index. So if a stock was added in 2008 and dropped in 2014, you'd only be taking the total return for that period. And then you simply bucket those constituents' total returns. So minus 100% to minus 50%, minus 50% to 0%, right the way up to more than 10x gain. And this is a clear example of a positive skew. You can see that the median is less than the average stock return in the S&P 500 for this period. And there's that long right-hand tail. Incidentally, this diagram perhaps helps to explain some of the challenges associated with stock picking, because unless you have a really reliable way of identifying in advance which companies are really going to outperform and most likely be crucial to determining relative performance compared to benchmarks, you're actually much more likely to own below average returning stocks simply because there are more of them. So that's just an interesting observation that can also be made from this chart. But if we just focus on outperforming stocks for a second, so you'll notice that the average S&P 500 stock posted about 370% total return in this period. So let's focus on that right-hand tail. And let's look at what proportion of those returns were captured by the S&P 500 and versus the S&P 500 equal weight index. And this brings us to the next slide. And what you can see is that in most categories among these outperforming stocks, you can see that the S&P 500 equal weight index captured a greater proportion of these returns compared to the S&P 500. And what I think this really speaks to is that rebalancing mechanism of equal weight. And specifically, contribution is a function of returns and weight. Now, many of us, I'm sure, can can name the largest companies in the market right now. But if we go back 15 or 18 years ago, the real challenge is perhaps identifying in advance which companies stand to benefit from certain trends. Now, when you think about equal weight, its smaller size exposure, that lends itself perhaps to capturing trends earlier on that benefit certain companies, because those companies have higher weights in the equal weight index compared to the S&P 500. And so to the extent that equal weight captures those emerging trends for these companies as they go on their growth journeys, that might help to explain this contribution. So certainly an interesting aspect for how that rebalancing mechanism may have helped the S&P 500 equal weight index to capture the greater proportion of those outperforming stock returns historically. Once again, will it continue? We'll have to wait and see, but the length of time studied here does suggest there is some reason there. So that's the end of my slides. There will be a Q&A session at the end, as Cameron said, so do feel free to post your questions, but otherwise I'll hand it back to you, Cameron.
Thank you, Hamish. Now I'm going to discuss how advisors might consider an S&P 500 equal weight exposure within their client portfolios. So, as Hamish just mentioned, and I'll briefly summarize, an equal weight US equity exposure is a concentration reducing strategy. It benefits from a return profile to the smaller segment of the large cap segment within the US. And you're obviously avoiding investing in those less liquid small cap names. Equal weight benefits from mean reversion, and it also offers greater participation to US economic growth. And finally, and we'll go through some examples here, equal weight offers an excellent opportunity in terms of portfolio construction for blending with other exposures within your investment portfolio. So we've got a couple of different implementation approaches that you might take for using an equal weight exposure within client portfolios. The first one really is as a long-term core allocation to US equities. Now, if we look at, we've seen a number of return periods, but any of these return periods show outperformance in terms of total returns of S&P 500 equal weight over and above the S&P index. And we know that equity markets in the US have performed very strongly in any case, but we see that over this roughly 25-year period, your $100 within equal weight will have grown to $1,310, which is just about 30% more than the S&P 500 index. For US investors, a lot of US investors will actually use equal weight as a core equity allocation in lieu of a market cap weighted exposure or active managers. So that's the first approach. The second approach is as a medium-term tactical or satellite position within client portfolios. And the reason that you may choose to use it in this way is that you might have a view that the economic outlook for the US economy is improving, that we're about to enter what might be described as the recovery phase of the economic cycle. The chart that we see here on this slide shows over a period of time going back to the 1990s, the US recessions, early 90 recession, the early 2000s recession after the dot-com bust, GFC recession, and the most recent COVID recession, all shaded in grey. The blue line shows the relative outperformance versus the market cap weighted S&P 500. And we can clearly see that the slope of this blue line, or this blue line, is appreciating markedly in periods post-recessions. In other words, we see that, as Hamish described, the equal weight approach captures more exposure to stocks that have leverage to an economic recovery. And we have hinted at it, but there does already seem to be green shoots in the US economy after the COVID crisis. It is obviously too early to say whether this will be a longer term trend, but that may be a reason why you choose to use it in client portfolios to add alpha. And the third approach, and I think this is probably most relevant for Australian investors, who most Australian investors will already have some US exposure within their portfolio. The chart that we see here on the slide shows the total returns of NASDAQ 100, S&P 500 equal weight index, the S&P 500 index, the market cap weighted index. And the final one shown in grey, light grey, is the NASDAQ 100 equal weight blend. So that's 50% NASDAQ, 50% S&P 500 equal weight blend. And the time period captured here is roughly 25 years. We're looking at a number of cycles, including the dot-com boom and bust, GFC, the recent COVID crisis, but also, you know, if we just look at, for example, the NASDAQ, we can see that incredible run that growth and tech have had over the last 5 years. And we know that a lot of Australian investors over this period have increased their allocation to growth and tech. They've sought that through passive or active funds, ETFs that track indices, active managers that skew towards growth. One example of that, of course, is BetaShares NASDAQ 100 ETF, which is the ticker code for that is NDQ, which tracks the NASDAQ 100 index, and that's received incredible support over this period. Now, the value of equal weight in this context is that it is an incredible diversification tool when paired with those growth exposures. If we look at the characteristics of an index like NASDAQ, in other words, a growth or tech index, we know that the profile for that includes exposure to secular growth. And by that, we mean long-term structural growth. It has a mega cap or large size bias. And it also is a momentum-based strategy or a strategy which benefits from momentum. If we look at equal weight, it's actually the polar opposite in terms of the factors driving that return. So equal weight is a cyclical growth exposure to that shorter term economic cycle, has a smaller cap bias within large caps, and benefits from mean reversion, the opposite of momentum. So the benefit here is of taking extreme ends of what we describe as a barbell. So either end of the spectrum, these exposures almost, you might describe, compete against each other or pull against each other. And that is a way to add diversification into your portfolio. When the return profiles move in opposite directions, you have lower correlation between those two investment exposures. And what that means is, as a whole, as a blend between these two exposures, we get volatility of a blend which is lower than the average of the two components. Also, if we are periodically rebalancing assets with a lower level of correlation, over time, we generate what might be described as rebalancing alpha. In other words, the total expected return of the blended portfolio is actually greater than the average return of its two component parts. So the impact of blending these, we'll just step back to the previous slide. The impact of blending these allows for a better outcome on returns, a lower outcome in terms of volatility, and as a result, that plays through to your risk-adjusted returns. And we show here Sharpe ratios as a measure of risk-adjusted returns. We can see them over this time period for the NASDAQ 100 and equal weight, 0.5, 0.56. The combined Sharpe ratio, or the Sharpe ratio of this blended exposure, is actually greater than either of the two component parts, 0.6, and also much greater than the index as a whole. Another way of describing this is that by using this blend, you're getting that strong growth that we've seen in the NASDAQ, a return very similar to that NASDAQ growth, but with a level of risk or volatility much closer to the equal weight index, and in fact, much closer to the lower volatility S&P 500 index. So a great outcome for investors. A final way to consider using equal weight exposures within client portfolios is, not every client will necessarily hold a growth exposure. We know that a lot of people may well have invested in the broad market, the market cap S&P 500 as a whole. And we saw a lot of inflows into the S&P 500 market cap index, from a period of over 5 years ago. It's important to obviously review investments within portfolio, and we note that the composition of the S&P 500 has changed markedly. And I think Hamish has highlighted some of those points in terms of the concentration. And we now know that the market cap weighted S&P 500 has developed more of a growth profile, has skewed towards momentum. Obviously, benefits of using equal weight together with that existing market cap weighted exposure mean that you can reduce that concentration risk, and you can draw the exposure profile back to where that was when you originally invested in the S&P 500 itself. So there are three approaches, and I like to think that there are ways that you can use equal weight together with existing exposures within client portfolios. So you can access the S&P 500 equal weight index that Hamish and I have discussed today through our BetaShares S&P 500 equal weight ETF, which trades on the ASX under the ticker code QUS. QUS tracks this index by buying all stocks in the index in proportion with their index weights. And so as a passive exposure, as you'd expect, it has a very low level of management costs, 0.29%. As with all investments, QUS comes with investment risks. There are no guarantees about the performance of QUS, and the returns may go up or down. Everything discussed today is general in nature. We have not taken into account any individual's personal circumstances. Look, I will point you to the BetaShares website. I think it's a great resource. Please go to the website, have a look under our funds and type in the ticker code QUS. From there you can see the PDS. You can also see the current portfolio that QUS holds, the full breakdown, look at past performance, and look at a number of investment cases or uses for this, potential uses for this exposure within client portfolios. That concludes the presentation part of our webinar today. So I think Hamish is going to join me back on camera. Thank you, Hamish. So we've had a few questions come through. I'll just try and sort of synthesize some of these. First question is for Hamish, I think. So look, during the presentation, I'll try and summarize this, but during the presentation, you talked a little bit about the index-based approach versus active management. Can you provide any color for this, or I mean, alternatively, can you point to some resources where people can go and understand a little bit more about this and the advantages there of that index approach versus active?
Sure. Well, I think clearly the active versus passive debate is evergreen, and there are proponents on both sides. And so recognizing that, S&P Dow Jones Indices has been informing that debate via a number of resources over the last coming up to 2 decades now. And the major way that we've informed that debate is via our SPIVA scorecards. So SPIVA stands for S&P Indices versus Active. And so as the name suggests, they compare the performance of active managers against their relevant and appropriate S&P index benchmarks. And we do an apples to apples comparison. So for example, large cap manager, large cap index, value manager, value index, and so on. And we also account for survivorship bias. Now the scorecard with the longest history is in the US, but we have since rolled these scorecards out globally. So across Canada, Latin America, Europe, South Africa, India, Japan, and Australia, there are SPIVA scorecards that are produced semi-annually. And we've also extended this to a risk-adjusted SPIVA scorecard, and as well as persistent scorecards. So to what extent does past performance inform future outperformance of active managers? And what the results typically show is that while you do get some shorter-term variation, perhaps over longer-term horizons, most active managers in most regions have typically underperformed their index benchmarks. Now, of course, what people do with that information, that's entirely their prerogative. But once again, that type of information is intended to inform the debate, and all of those resources are available on our website, spdgi.com.
Great, thank you, Hamish. Another one that I'll throw to you. How does the equal weight exposure compare to a value-specific exposure? How does equal weight compare to a value-labeled exposure? Can you give us some context there?
Sure. Well, from an index perspective, so a value index typically focuses on targeting that value exposure using various fundamental ratios to define value and then looking at a universe and then tilting towards those value names, or indeed excluding things which are not value and are more on the growth side. Now, as we saw in one of my slides, Equal Weight does have a value tilt compared to the S&P 500 at the moment, but I think a lot of that's driven by that smaller size exposure, where at the moment, many of the largest names in the market have that growth bias, if you like. And so the fact that Equal Weight tilts away from those and into those smaller names which have that value bias, that helps to explain or some of the differences between the two indices. And I think historically, if you look at returns as well, if you look at values returns versus Equal Weight, the fact that Equal Weight does still have some allocations towards growth names, which a value index, for example, may exclude, certain differences along those lines may help to explain why Equal Weight may have fared relatively better over the last few years, when I think it's a well-known observation that value has and value indices have not necessarily offered that great returns over the last decade or so.
And if I could just add to that, in terms of what we see from putting portfolios together, we certainly see that there is a value tilt and cyclical tilt in Equal Weight. But if we compare returns on the two, and I was looking at this recently, we do tend to see that value, when it does draw down, it does take a lot longer to recover before snapping back in terms of performance. So, you know, I would suggest that an Equal Weight approach is perhaps a better asset or a better exposure to blend with growth exposure than value, due to that drag that you sometimes get with value. I think, you know, Equal Weight has certainly outperformed over the last year versus value, for example, while it has a value tilt itself. Next question I'll take. There was a question about that barbelling slide. I mean, that was looking at the barbell over, a 25-year period, and the question was, does that barbell approach still work over the last, sort of 5 years when Equal Weight has underperformed the broad benchmark? And so, look, just to respond to that, the answer is yes. So, by combining a growth exposure with Equal Weight over that shorter term time frame, even though Equal Weight has underperformed, it still produces better risk-adjusted returns than the S&P 500 market cap weighted index. However, if you do look at the component parts, NASDAQ, because it's had that incredibly strong growth run, as a single investment, has a higher Sharpe ratio due to those strong returns. Nevertheless, I think we'll all agree it's very difficult to predict the future returns 5 years in advance. And so what I would suggest is that the diversification element that you're adding, and the fact that we can't predict the future in terms of different exposures outperforming, lead me to believe there's a strong case for barbelling as opposed to picking one or the other. We also have a question here with regard to so the index methodology and how that impacts. So does the quarterly selling of high performing companies create more of a CGT obligation? And I can probably maybe open with this one and then throw to you, Hamish. But so look, yes, to a degree it will. CGT in ETFs in Australia it can be the result of turnover. And it's important to note that the S&P 500 index over the last year, I believe, has had turnover of 5%, versus the Equal Weight around about 20%. So all indices will have some degree of turnover due to stocks coming in and out of the index. Take Tesla, for example, and also corporate actions. So a degree of turnover there. I would suggest that the turnover over the COVID period is likely to be higher due to the degree of return dispersion we've seen due to very choppy markets. And if we enter a more stable market cycle, turnovers should drop, and that therefore means that your any CGT output from that would also be reduced. So that's my response. Hamish, did you want to add to that or anything?
Nothing to add from my perspective. The only thing I would say on the rebalancing schedule would be in my slides. As I said, I think the quarterly rebalancing from a historical perspective appeared to help the Equal Weight Index to identify and benefit perhaps from those emerging trends and companies that benefit from those trends, while not becoming overly reliant on the largest names in the market.
Yeah, so if you like, the benefit of rebalancing certainly outweighs the cost from a historical perspective, of course. Okay, so look, thank you very much. I think that's all we have time for today. Look, we really appreciate you taking the time out to join us. And we know that a lot of people on the line have been great supporters of our fund, have used our fund. We certainly hope that you find BetaShares ETF exposures to be transparent, true to label, and have delivered good portfolio outcomes for your clients. For those of you that have not yet used BetaShares funds, we encourage you to reach out. We're happy to help with any information about using ETFs generally, or our particular exposures and what they offer. Thank you, Hamish. It's been a pleasure to have you on the line. Thank you, everyone, for joining us, and we hope you enjoy the rest of your day.